You're losing over $375,000 because of this one investing mistake. And it's not bad stock picks. But don't worry, I've helped millions improve their finances, and I'll share a 3-step checklist to fix this without investing a dollar more. But before I share the 3 steps, you need to know what that mistake is. Research by Morningstar shows that over the last decade, investors earned about 7% per year, while the funds they were invested in made about 8.2%. Think that 1.2% is nothing? That small gap makes you $375,000 poorer by the time you retire. The worst part? It isn't from fees or bad fund choices, it's from your behavior. But why does this gap show up at all? Here's the twist nobody expects. It's not some hidden trick by fund managers. The problem is when people decide to put money in and take money out. Let's say 2 people buy tickets to the same concert. Sarah buys early at face value, and Jason waits and pays double on resale. Same show and same seats, but very different prices. Investing works the same way. If you invest more money after the market already went up, or sell when it has dropped, your average return ends up lower than the fund's official return. The research shows it gets even worse in certain types of funds. Sector funds like tech-only or energy-only show a big gap. The funds earned around 8.5%, but investors only got 7%. Why? Because people pile in when the sectors are hot and bail when they cool down. On the other hand, balanced funds and target date funds have almost zero gap. Investors earn about the same as the funds themselves. This is proof that the biggest enemy isn't the market, it's our own timing. And that's why this next part changes everything. How do you fix this? The data is clear. Trade less and use all-in-one diversified funds. I know that sounds boring, but boring is what wins. Why do you think target date and balanced funds have almost zero gaps? It's because they automatically rebalance for you, and most people just leave them alone in retirement accounts. That means you make fewer emotional decisions and end up getting almost the full return. On the other hand, the more people jump in and out, the worse they do. In fact, ETFs, the low-cost, super popular funds, show one of the widest gaps. The funds themselves returned about 9.5%, but investors only got 7.8%. Because ETFs are so easy to trade, people treat them like slot machines. So the lesson is simple. The less you tinker, the more you earn. What I'm about to share next flips the script for you. Here's your checklist if you want to stop missing out on returns. Pick a diversified all-in-one fund. A balanced fund or target date fund works great. But of course, choose what's best for your goals and risk tolerance. Automate your contributions. This way, you're adding money consistently no matter what the market's doing. Commit to fewer trades. Make a rule like, I will only sell or buy out of turn if I need to rebalance based on my written plan. This keeps emotions out of it. Follow these steps and you'll avoid that 1.2% gap that eats away at long-term wealth. But to truly boost your returns, you must earn more and invest more. Watch this video to 5x your income using 3 unwritten rules.